Any case, today we're going to talk about is cash balance pension plans. And there's something probably a lot of people don't think about or know too much about. So we thought we'd take a few minutes to go through how a cash balance plan works, if it can work for you, if it's the right kind of program for you, and tell you the mechanics of them behind the scenes. So then the introduction here, really, I wanted to tell you about, there's two kinds of pension plans or cash balance pension plans. One would be for a larger employer, a bona fide employee benefit program. The other type, the type that is much more popular now, is for plans for professional firms and highly successful companies. So that's the scope of what I'm going to be talking about today. Smaller companies, very profitable, and want to shelter and build significant income for the future. Now, a pension plan, you know of the word pension plan. You don't see too many of them around anymore other than government plans, but a pension plan provides monthly income at retirement. What we do in a cash balance plan is change that so it looks like an account balance. That's the nature of a cash balance pension plan, is taking a promise, a monthly benefit promise, and making it look like an account balance. So it looks a lot more like a defined contribution plan, a 401k plan, for example, but it's different. Some of the advantages is you can have very significant tax deductible contributions. This all depends on your age, all depends on your compensation, but we see them as high as almost $300,000 a year for an individual to accumulate for retirement savings. Now, that would be somebody starting very late in their life and trying to accumulate rapidly. But it's used even at younger ages where you want to accumulate funds rapidly and let them grow to enhance your retirement plan benefit. You can be very flexible with these types of plans. And what I mean by that is the contribution does not have to be the same per person. Oftentimes you think of a retirement plan and you think as a flat percentage of pay. Everybody receives 3% of pay, maybe 4, maybe 6. Doesn't matter. In cash balance plans, we take ages, we take life expectancy, and we can build individual contributions for different individuals or maybe groups of individuals, which is most commonly used. It's important for clients to understand that a cash balance plan is truly a defined benefit plan. And the reason that's important is because they'll need to work with the financial advisor very carefully to manage the assets, because in a pension plan or cash balance plan as well, you're shooting for a target with your investments. It's different than a 401k where you're saying, I want to accumulate as much as possible. In this case, you do want to do the same thing, but you also want to manage risk because you're responsible to make sure the funding is there when that person goes up to retirement age. Now, the next slide, there's two different types of plans. And I'm thinking back now, I've been in the business many years, and I'm thinking of my first day of employment where I went into my boss, I just graduated from college, and talked to him about different retirement plans. And he took the time to explain to me these two broad types of retirement plans. One is defined contribution plans. And just as the name states, you're defining a deposit or a contribution to the plan. The most popular plans nowadays are 401k plans. So the defined contribution is the person elects how much they want to save. That's piece one. The employer may match. That's piece two. And the employer might have profit sharing, which is discretionary contributions in addition to salary deferrals and other contributions. But once the money goes in, the contribution has been defined and fulfilled, then it moves to the hands of the employee. Their investment performance is going to be based on what they invested in. So as it grows, they enjoy the growth and they also suffer the losses of any down markets. That's the nature of defined contribution plans. Rather simple, they're account balance based, and what's there is there, and it grows and shrinks each year with investment performance. The other broad type of plan is a defined benefit pension plan or defined benefit plan. This is different. Instead of defining the contribution, you're actually defining the benefit that will be paid out of the plan. Then it's the employer's responsibility to fund for that benefit. So you could see it operates differently. There's more security or less investment volatility to the employee in a defined benefit plan or an account cash balance account compared to the defined contribution plan. So defined contribution tells you about the deposits. Defined benefits defines a fixed benefit when you terminate or otherwise retire. Now, I thought I would look at the different limitations for the two different types of plans. So that appears on the next slide. You see the defined contribution limits. These are government limits. They're in Internal Revenue Code section 415. They define how much can go in a year, the contribution limit. There's an annual addition of $57,000 a year for 2020, and that was recently increased to $58,000 a year for 2021. That includes salary deferral 401k contributions. That's what a person elects to put into the plan out of their pay of $19,500. It includes the match, if there is one. It includes the employer safe harbor contributions. Those are special contributions an employer can make to a 401k plan so that they don't have to do some of the non-discrimination testing. And it includes the profit sharing discretionary contributions from the employer. That limit mentioned above, 57,000, does not include, if you're age 50 or older, the special catch-up contribution of $6,500 a year. So those are the limits on the contributions that can go into a defined contribution plan. Defined benefit plan has a different limitation. So on the next slide, you'll see the defined benefit plan actually limits, it's in code section 415 again, but it's different. It says you can have a plan and you can never have more than a $230,000 annual pension benefit. So the limit is limited based on the benefit coming out of the plan. Now those rules go on to say it can be never more than 100% of your 3-year average compensation. So if you make $50,000 a year, you can't have a $230,000 pension benefit, but you could have a $50,000 pension benefit. And the other requirement is you have to earn this benefit over a period of at least 10 years. In other words, you can't say, oh, I want to start a pension now, and I'm going to give myself 100% of pay for 1 year of service. It has to be spread out over the 10 years. So those are limits. On the next slide, what we're going to do is just have a concept of present values. And the reason I want to talk about this is because this is the concept or the methodology that we use to design cash balance pension plans to work to the best interest of what the employer would like to accomplish with their plan. So what I did here, I have several illustrations. I'm just going to focus on the left-hand column, the owner. In this case, the owner earns $200,000 a year. The owner's age 60, and I made up a formula of 2.5% of monthly pay per year of service. So you could see in this particular formula, and that formula happens to be the state of Pennsylvania and a lot of governmental plan formulas. That's why I picked it for illustrative purposes. In any case, the owner works a year of service. He's earned a benefit of $416 a month, payable at age 65. And we would need to set aside, using a 5% effective interest rate, $56,000 for him that year to take care of that benefit starting at age 65 and then being paid monthly for the rest of his life. Let's go all the way to the other side, the employee number 3, who earns $25,000 a year. It's 1/8 of the owner's pay. So as you would expect, the monthly benefit, which is based on pay, is $52.08 a month, 1/8 of the $416. Then you calculate the present value and it's only $1,271. So the concept here is you put $1,271 in the trust fund today. It grows over the next 40 years with 5% effective interest rate for the illustration. And then you can pay that person $52 per month for the rest of their life. So if you compare the 56,000 to the owner, because he's older and higher paid, to the $1,271 to employee number 3, who's very young and lower paid, you see there's a significant difference in the contribution required to provide that same 2.5% monthly benefit. As an example, I think the difference is 44 times greater. So this owner, his pay is 8 times greater, but the contribution requirement is 44 times better because of the less amount of time the owner has to accumulate funds within the plan. That's a present value concept, how these numbers work, and this is what's behind the scenes in almost every one of our design concepts. So how do we begin on the plan design? So when we have a potential customer, they come to the firm, and typically we always want the simplest, most effective plan for them. In today's world, the plan of choice is typically a 401k plan. It usually has a safe harbor employer contribution. And that just means the employer agrees to either put in 3% of pay and fully vest it right away, or have a match dollar for dollar on the first 3% of pay and 50 cents on the dollar on the next 2% of pay and fully vest the match, or something better than those two. And that takes away the discrimination requirements for savings amounts. Then I could save the 19,500 should I be able to, and nobody else has to participate, and it's still okay. That's what the safe harbor gives you. Almost every one of our plans, and Brooke may have talked to you earlier about this in a prior session, will have a discretionary profit sharing feature. She does this person by person so that you have tremendous flexibility in your defined contribution plan when allocating employer contributions. Now, you might do it as a percentage of pay for everybody to keep it simple, but the flexibility is there to do something different. So with that as background, what if you're very successful, your income is somewhat predictable, you want to increase income tax deductions, and or you're behind on your retirement savings goals? That's often the case with business owners who have invested a great deal of time and money in their business in their younger years, and then actually are earning the money in their later years. Well, those are the people that consider a cash balance pension plan. So I thought I would take an example, a sample case. We receive, probably 40 or 50 requests a month in terms of people wanting to know whether this makes sense for them. So where we start, this happens to be a female-owned, small, successful business, actually a very successful business. The spouse works in the business and has been added to payroll. They just attained age 50. They don't have much savings for retirements. They're in an IRA. They take a very low W-2 earnings and a much higher sub-S distribution. Now, the point there is a lot of times there's flexibility here. You can increase your W-2 earnings at the expense of a higher sub-S distribution, which isn't counted for pension purposes or retirement plan purposes. So they said to us, what can we do to accumulate savings? So what we illustrated, we started with the 401k plan that I mentioned. So on the next slide, you'll see kind of a projection of just one of the two. This is one of the owners, and then the spouse would be identical if they take the identical pay. But what we had to do is we increased their W-2 pay to $150,000 per year, and we looked at a 401k plan to maximize it. And what you see here is they put in 19.5 of salary deferrals each year from age 50 to 64. There's an age 50 catch up. There's a maximum employer profit sharing of 37,500. If you add those across, it's 63,500 as the maximum contribution. And that's the 57,000 per year, the limit, plus a $6,500 catch up. And all I really do here is I project it forward with an assumed 7.5% investment return. And lo and behold, after the next 14 years or 15 years of deposits, they would have accumulated $1.5 million in their defined contribution plan. Now that can be greater, that can be less, depending on the actual investment return of the plan. So that's where we started, and we presented that as an option. And the answer was, well, we're doing really well. So we'd like to look at what else can we do to supplement this and build our retirement income. So the next slide, we introduce the concept of a cash balance pension plan. So I'll go to the right under the cash balance pension plan. And what we could design is we could give them each a deductible contribution of $150,000 a year. It will grow with a fixed rate of interest, 5%. And as you can see, it projects down and it accumulates to a very significant amount over the next 15 years. Here's the difference. That ending account balance, no matter what year you pick, is what should be or must be in the trust fund to pay the benefits under the plan. If the investments perform rather well, the 150,000 contribution will decline. If the investments perform poorly, less than 5%, the 150,000 will increase. So you see, we just shifted some risk from the employee's investment account balance to the employer as a deductible cash balance contribution. Now, we have all sorts of techniques to control that. We always like a plan to be pretty well funded year after year. Every year we do a study and make sure the plan is in good order, and we monitor that. So year after year, we take a picture and say, where are we? Where should we be? What should you contribute? How much flexibility do you have? Because sometimes you can find they can put in more money in a year to build a cushion for an anticipated bad year. But the concept is there, and you can see how significant the difference in the contribution requirements. Now we went on a step further, and because the 150,000 wasn't even enough yet, and added a smaller 401k plan to the total. So the 401k plan allows them to save the 19.5 and the catch up $6,500. It also can accept up to 6% of pay as an employer contribution. That is a limit when you have combined plans. And so we designed this plan to be a combination plan, which is most of our plans, and partly 401k, a more modest 401k, and a cash balance supplement. So the next illustration is just a graph of how these would accumulate. So you see you're comparing the blue 401k only to the 401k, smaller 401k, and cash balance plan combined. And you see there's a significant difference in how you can accumulate monies from age 50 until age 65. Let's go on to a different situation. So here's another client. It's a successful law firm. There's two owner partners with W-2 income at the maximum allowable. That's $285,000 per year. So if you made $500,000 per year, we can't count that in designing a plan. We can only count up to $285,000. They also had, this law firm, several highly compensated attorneys earning over $130,000. That's the break point for you to determine if you're a highly paid person. Now, the interesting part here is the government protects non-highly paid people making less than that. If you're making over that, there's not that much protection for you. So in this particular case, we could even exclude them from the cash balance plan. And that's what the owner partners wanted to do. They say these group of attorneys want to make their money. They don't care as much about deferrals or tax deferred money. So we're going to exclude them from the employer contributions to our plan. Then they went on to say, however, we have an administrative staff and paralegals who are extremely valuable to us. We want to include them. They're used to something a little bit larger, and we want to include them in this plan. So the goal that they asked us to try to accomplish is to maximize owner employees and still provide a competitive benefit for the staff. So what we came up with is a cash balance 401k combination. The cash balance plan gave owners 50% of pay, which is $142,500 each. It allowed them to save the $19,500 salary deferral amount. I'm going down the first column. We also are giving them a 3% of pay safe harbor contribution in the 401k. We didn't include them in any profit sharing contributions. We needed not to, so that we could get the 50% of pay cash balance up above. But the total deposit for the sum of the two is $341,100. So they're really happy compared to the current limits. Then we slide over to the next column, our 15 highly compensated employees. We excluded them from the cash balance plan altogether. They can still do the $19,500 plus catch up if applicable. And we excluded them from the safe harbor match in the 401k plan and the profit sharing contribution. So they don't really cost the employer any benefit dollars because they prefer to have higher compensation. And lastly, the last column is the 10 qualified staff, 60,000 average, 3.5% of pay, 19,500. Then we gave them a 3% safe harbor, a 2% profit sharing, and lo and behold, they cost that group of 10 people $51,000 per year. And the client liked this design, satisfied their goals, and we moved forward with the plan. So next, I guess there are things, I make it sound kind of simple, but behind the scenes, there's several different tests. I won't go into any detail on these, but there's lots of tests to look at and make sure they work out. You have to make sure you're treating the non-highly paid people adequately enough to support the benefits for the highly compensated employees. We take age into account, those present values I talked about. We take compensation into account and do somewhat complicated testing to make sure everything passes. So important items to consider. So on the next slide, you'll see there's three primary areas that I think you want to pay attention to here. One is employee demographics are important. I just showed you leveraging age within the plan, but what if you're a real small employer and you have an assistant, or another employee that's 30 years old today, and that person terminates employment and you hire a 55-year-old? All of a sudden the demographics are very different, which will impact how we manage this plan and what we have to provide into the future. So that's just something to keep in mind. These plans work best for older, more highly compensated employees. The older you are, the better it is. And they start making real sense, probably at about age 40 to 45. Then you want to monitor plan funded status. So we want to keep this plan well funded. We don't want too many surprises here. We want the plan well funded, but not overfunded. So market fluctuations up or down will impact future contributions. And you're allowed to pre-fund within allowable limitations. And you also want to be careful with excess assets. And lastly, the thing to remember, it is a defined benefit pension plan, which means when a person does retire, they could elect to take that lump sum and turn it into a monthly benefit, in which case you would pay a monthly out of the plan, or you would buy an annuity. And there might be a little difference. There is always a little difference in the annuity pricing versus the cash balance account when a person goes to retire. So really with that, that's most of it. I hope the concepts came through. There's tremendous opportunities here, but there's also some things to be careful for. So we have an experienced team. It includes our sales team, the actuaries, and the actuarial consultants that help in the plan design. So this team will help you design the plan to best satisfy your goals. Together, Definity has over 600 cash balance slash 401k combination plans nationwide across the nation. And we do quite a bit of work every day just modeling and testing and seeing if the plan makes sense for you, or possibly if you're a financial advisor, one of your clients. The last thing is, if you're interested, you just reach out to Definity. We'd be happy to help. You provide us with an employee census information. You define the employer objectives. They can be real brief. I want to maximize for the owners, or they could be more complicated, more detailed. I like this group of people. This staff is more valuable to me than that, etc. Then you would think about how much flexibility you have if you're the employer in terms of W-2 pay versus sub-S type distributions or pass-through income. And what we'll do is illustrate possible plan designs, give you some suggestions, and if it makes sense, if it's suitable for you, we'll implement the plan and administer it into the future. So that's what I was hoping to tell you today about cash balance pension plans. Are there any questions at this time?
Yes, Dawn, there are some questions. And I'd remind those who are watching, if they do have other questions and they've not had a chance to enter it into the Q&A tab, to use the Q&A tab at the bottom of your screen, and you can enter those questions. But we do have a question. Patrick wanted to know, is there an advantage of lowering the profit sharing contribution and then adding the cash balance versus keeping the profit sharing and then modifying the cash balance plan contribution?
That's a good question, and it has to do with income taxes. So the reason in my illustration I reduced the 401k down to 6% of pay as an employer contribution is because the government says when you have combined plans, if you're doing 6% of pay or less in your 401k, you can also do and take a tax deduction for the cash balance amount. If that were greater than 6%, we would have to reduce income tax deductions. So unfortunately, unless your plan is covered by the Pension Benefit Guaranty Corporation, which would generally be a larger employer, but unfortunately we always cut back the 401k to the 6% of pay from the employer with salary deferrals and add it to the cash balance plan.
Good. What is the extra cost if a separated participant wants an annuity? For instance, the lifetime payout versus cash out IRA. Is there something that you can define?
You have to actually shop for the annuities. So you go out to various insurance companies and get pricing on the annuities. We do this for a lot of traditional pension plans on an ongoing basis. Generally, we see about a 5 to 7% differential, because the way we value the pension benefit is using high quality corporate bond rates, which are very low right now, which makes them expensive. But annuities, the insurance company builds in a little profit margin and a risk margin. So you would expect to always pay a little bit more.
Good. There is a question about how to get a hold of us, and I'm going to address that in just a second. But Don, we do have some other questions that I kind of wanted to make sure we had a chance to review. You mentioned about overfunding a cash balance plan. What happens if cash balance plan is overfunded? Does that mean we're limited on the contributions? How is that handled? Just address that.
That's probably one of the biggest concerns about cash balance plans, or the thing to pay closest attention to. Because if you have an overfunded plan at the time of terminating the plan, then you are subject to an excise tax on the reversion of the funds to the employer. So in other words, you filled up your bucket to the maximum allowable by the government, and then you have a 20% return on your plan investments. Lo and behold, we have too much money in the plan. If I were to terminate it at that point in time, I have to take that money back to the company, pay taxes on it, and an excise tax as high as 50%. So it's very bad to be overfunded at time of termination. The flip side is you can overfund in all those prior years, and then near the end of the term of the cash balance plan, don't put in contributions, but still accrue or earn a benefit and absorb that overfunding. So that's one of the things that you pay closest attention to. And the longer the plan goes, the bigger it gets, the more attention you need to pay to it. Most employers have these plans about 5 or 6 years, and then they get a little bit nervous with that risk. So they terminate them. They partially filled their bucket and move the money over to their 401k plan. Now it can grow freely.
Yeah, that's great. Good. Thank you for that explanation. What about who figures out how much of the contribution should be each year? Is
That
that,
would be us.
yeah,
Yes. So what we do is we prepare an annual valuation and we give you a minimum required contribution. There are funding rules and a maximum tax deductible. And then the employer, based on their tax situation and whether they want to build a reserve or not within the plan, would decide how much to put in the plan.
okay. Here's another question. This one's from Michael. After you implement a cash balance plan, is there a certain period of time where you're required to maintain the plan?
Also, a very good question. And there is. Retirement plans are intended to be permanent in nature. Now, permanent sounds a lot like forever, but really the general rule of thumb is almost always you should plan to have one for 3 years. And 5 years is even better. So we like to talk to employers and say, you shouldn't do this if you're having a bang up year and next year you're not going to. You should make sure this is a plan that's going to be around at least 3 to 5 years.
Good, good, good. Here's another question from one of the attendees. How often, let me make sure I read it correctly. How often do separated participants take the lifetime payout versus a payout?
It's fair. That's another good question because this is really
We
interesting
got
to
a
me.
smart group here.
We do. If you're in a regular pension plan where all along you've been thinking about monthly benefits, generally it's about a 50-50 split. Oddly enough, it's the same kind of plan, just presented differently over the years. People in cash balance plans almost always take the cash balance plan, and it's rare that they ever buy in and have to buy an annuity. So it's just an odd situation where the presentation to the participant over their career will make a difference on their patterns of electing their distribution at retirement.